Good afternoon and welcome. You're watching the Mutual Fund Corner. I'm Mangla Malu. With me in the Mutual Fund Corner is Sumaira Abdi. This is the show where we answer all your mutual fund related queries. Before that, a quick look at the markets before we hand it over to Sumaira. While it's a down day of trade, but the Nifty has recovered a bit from the lows of trade, currently hovering around the 10,900 mark. The Sensex too around the 36,400 mark. The mid-cap index underperforming with a cut of about 0.5%, rather in line with how the frontline indices are trading. But just in the last hour, we have a lot of these stocks which are buzzing, so a handful of them should come up for you. The likes of Interglobe Aviation up about 5%. Today we got some domestic passenger data, and Interglobe Aviation seems like Indigo has gained some bit of market share out there, along with an increase in the passenger load factor. So that stock is up higher by about 5%. And Havells, the results came in. The margins were below what the street expected for 2 quarters in a row. However, the company said that going forward, the margins are likely to improve on account of lower commodity prices, and which is why we're seeing a recovery on Havells as well. But on the downside, we have Prabhat Dairy now down about 25% from the highs of the day. The street would have liked the company to go ahead and the promoters to perhaps sell their stake and there be an open offer as against selling a subsidiary which includes 98.5% of their business. But first up, all the top stories, and then we hand it over to Sumaira. The market recovers but still 0.5% down. Kotak Mahindra Bank supports, but heavyweights HDFC Twins, Infosys as well as ITC exert pressure. Mid-cap index down in line with the frontline indices. Sun Pharma stock surges after the company takes remedial measures following reports of whistleblower complaint. cnbc TV18 Newsbreak confirmed as Sun Pharma will transfer domestic operations from Aditya Medisales to ARM. Company also denies having given any loans or any guarantees to Suraksha Realty. Central banks everywhere must be independent to ensure macroeconomic stability. That's the word coming in from IMF chief economist Geeta Gopinath. She also adds that the central bank reserves are fickle and must be managed carefully. FY20 is likely to be a challenging year for IT services industry, with growth being flat or moderately lower. Offshore Insights says IT companies to be impacted by a drop in tech spend. And CRISIL's downgrade of debentures of Island FS SPV Jharkhand Roads to D. ICRA puts mutual funds which have exposure to Island FS special purpose vehicles under rating watch, but experts say the court will decide in favor of the established norms of ring fencing and escrowing cash flows. With that, we hand it over to Sumaira, who is in the Mutual Fund Corner. Sumaira.
Mangalam, thanks very much for that. I have my expert here with me as well. Sharad Singh, founder and CEO of Investor.com, joins in this afternoon to answer all the mutual fund queries that are coming in. Sharad, hi, good afternoon. Thanks very much for joining in. Our first query comes to us from Ronak Rajpal. He's written to us from Mumbai. So he wants to know whether or not he should invest in the IDFC multi-cap fund. So, he's taken a very specific view. We don't know what the rest of his portfolio, etc., looks like, but he's a young investor. He's 23. Is this the route that he should take?
I think that's fine. Yeah, a person should decide what are the goals. Why does he need the money? When would he need the money that he's investing in? Largely, the fund is fine. A young person investing in mutual funds is a good start. What I would suggest is have in mind when do you need that money, what are your financial goals, because asset allocation becomes very important when you start investing in mutual funds. So for a goal, for a need that you might have 2 years, 3 years down the line, equity may not be the right choice. However, if you are investing for your retirement, equity is the only choice to begin with.
All right. So I hope you were listening in to that. We have another query coming in, this time from Pranav Kulkarni. He's written to us from Mumbai. So he has investments in multiple mutual funds. He wants his portfolio to actually be assessed. So he's 19 years old. He's a student. He has an SIP ongoing in the Mirai Asset Emerging Blue Chip Fund, which is 1,000 rupees. Almost 1,000 in the L&T Mid Cap Fund, HDFC Small Cap Fund. He has the ICICI Next 50 Index Fund. So he wants to actually have his portfolio reviewed, and he's looking to remain invested for the next 15 years. And the goal that he has in mind is retirement. So he hasn't mentioned the amount, the corpus that he's looking to collect, but is he on the right track?
Yeah, good. 19 years person is starting to invest in mutual funds. Absolutely great. Now, you are targeting early retirement, which I believe you said is 15 years down the line. Now, currently you're investing around 5K per month as of now. When you start working, after say 5 years from now, when you're 24 or 25, I believe you will increase your SIP to 25K per month or 30K per month, which will keep increasing. So considering that amount of SIP which you will do starting 5 years from now, at the end of 15 years from now, you would have perhaps 1.5 crore as the retirement corpus. So you need to think whether that is sufficient for you at the age of 34, 15 years from now, because you would have almost, considering a life expectancy of 90, you would have approximately 55 years to live and spend that money. So look at what is the corpus that you need to build and accordingly plan for that.
Okay, our next query comes in from Gaurav Bedi. He's written to us from New Delhi. So he also is looking to actually have his portfolio assessed. So he is a professional. He's about 24 years old. And he has 4 SIPs which are ongoing. That's the Axis Blue Chip Fund, HDFC Small Cap Fund, Tata India Consumer Fund, as well as the Tata Digital India Fund. In all of these, he has a direct plan, 5,000 rupees a month in each of these funds. He, Sharad, interestingly says he's going to increase his monthly SIP to about 30,000 from about 20,000 currently. So that as well is something which is quite a positive thing. He wants to buy a house in about 10 years' time and is looking for 1.5 crores by way of corpus. So the good thing is that he already knows there is a shortfall and he needs to, step up and increase money going forward. But despite that, does it look that his target is too aggressive, or you think he'd be on track to meet it?
Yeah. So if you look at 1.5 crore after say 10 years for whatever amount he's investing, it is an aggressive target because the return expectation is around 19-20%, which is pretty high. You would not get that return over a period of time, especially considering that your equity proportion would go down as you reach your goal. So one way to look at it is, say you start investing 30K per month and assume that every year you step up the SIP further by 10% or so, you'd be able to reach somewhere around a crore plus minus 10%. And the rest you should plan to take a home loan. Home loan is a good thing. If you're buying your first house, you can always get tax incentives on that. So you create a corpus of 1 crore and you take the home loan for the rest portion of it.
All right, up next, Alpesh Kantharia has written to us from Mumbai. He has investments also in multiple funds. So the good thing is that a lot of people are writing in now to have their portfolios assessed. So he is about 32 years old. His portfolio is as follows. He has the Axis Long-Term Equity Fund, which of course is an ELSS, where he has an SIP of 1,000 rupees. Reliance Tax Saver Fund, another ELSS, with a SIP of 3,000. Mirai Asset Emerging Blue Chip Fund with 1,000 rupees SIP. HDFC Mid-Cap Opportunities, 5,000 rupees SIP. ELSS Mutual Fund, he says, has completed investment of 4 years, and he is actually concerned about the Reliance ELSS. Should he continue with it or exit? Now the thing is that he has SIPs ongoing in the ELSS funds. Actually, I wish we would have spoken to him because, if he's done it for tax purposes, then it's excellent because we don't know of too many people who have, SIPs ongoing in ELSS schemes. But nevertheless, he does have a time horizon of 15 to 20 odd years. So how would you assess his portfolio?
So when people invest in ELSS funds, and that is a part of their portfolio for growth or for any goal, they should always remember that number of ELSS funds are limited, and you need to keep churning the existing investments that you have done in an ELSS fund after 3 years, because 3 years the investments mature, and you can keep churning that rather than investing new money in any ELSS fund. That will suffice for your ATC needs. Having said that, now look at the other part of the portfolio, other goals, etc., that you may have. And depending on the goals, you need to set the asset allocation. For the long-term goals, of course, you can get into equity. For short-term goals, look at a mix of equity and debt. I would not review a fund or get too much concerned about a fund, especially if we see the last 1 year where a lot of funds have taken a beating because the index moved up due to a few stocks only. So I'll not be very concerned about looking at the funds right now, but you can keep reviewing it. On the tax saving side, you can look at Tata Tax Saver, DSP Tax Saver, which are good funds. But I won't be very concerned about tax saving funds per se. I would look at largely the goal that I'm investing for and look at my asset allocation largely from a long-term perspective.
Okay, up next, Amit Rathore has written to us from Bengaluru. He has investments in multiple funds. And once again, here is a person who's looking to have his portfolio assessed. He's 32 years old and he wants to actually accumulate a corpus for the many goals that he has. He started investing about 6 months ago. He has SIPs ongoing of 40,000 rupees a month with the direct options that he has chosen. So he has the SBI Focused Equity Fund. This he is invested in because he requires 50 lakhs after 12 years for buying a house. The Motilal Oswal Focus 35. Here he requires 1 crore after 20 years and he's investing about 8,000 rupees. For child education, he has chosen the Mira Asset Emerging Blue Chip Fund where he requires 4 crores after 28 years for retirement as well. And L&T Emerging Business Fund where he requires 1 crore after 25 years. The Aditya Birla Sun Life 96 tax relief. Here he requires 20 lakhs after 10 years for travel and expenses. He's not mentioned tax anywhere. He's contributing 5,000 also for NPS on a monthly basis for tax exemption. And he's taken about a term plan of 1.5 crores. So he wants to know if or not any sort of changes are required. So one is that he has clearly linked his goals to each of his investments. Yep. My only concern is that for every goal, his fallback is only one fund. Is that all right? Or do you think he should perhaps be spreading the risk a little bit more?
Yeah. So good that he has identified his goals and he's investing for the goals. Great that you have a term plan as of now. Answering the first part of the question, whether one fund for a goal is good enough. As of now, because the investment size is small, it's fine. And overall, the portfolio is diversified for various goals. He has different funds, which is fair enough. What I see is as per the target and the time frame that you have in mind, Amit, the investments would not lead to the exact target that you have set up. Having said that, we understand that as we go ahead, the salary increases and you would save more portion of your salary and you'd be able to reach the goals. So try and step up as much as possible. Maybe look at in the next 4 to 5 years, doubling the amount of investments that you are doing for your goals. And I think you're on the right track. In a year or so, as your investments for any goal start crossing 10,000, start looking at if you could segregate the investments into more than one fund so that there's a bit of diversification. Look at for a particular goal if you can put some amount in large cap, some amount in mid cap or multi cap. So there is diversification across market caps. But largely, I think you're going pretty good and you have a good thought on all the goals that you have mapped to your funds.
All right, so those are as far as the mutual fund queries are concerned, but just keep an eye out on the markets. We've recovered a goodish bit from the lows. In fact, the mid-cap index has virtually broken into the green. If we speak about the moves on that index, are down by just about 18, 19 points. And a lot of the stocks they're leading it. Strides Pharma, for instance. All right, okay, we're getting in news from Davos. Shireen Bhan in conversation with former RBI Governor Raghuram Rajan.
We're continuing our coverage here from the World Economic Forum's annual meeting in Davos. And joining me now is the former Governor of the Reserve Bank of India, Raghuram Rajan. Sir, thanks very much for joining us here at CNBC TV 18. The mood here is one of caution and pessimism. If you look at the IMF forecast, or you look at the PwC CEO survey, all seem to be pointing to downside risk to the global growth and global economy. What's your own take? Do you believe that the pessimism is overdone?
Well, I don't think it's overdone. I mean, what we have is a still reasonable recovery, but with increasing risks. Of course, the biggest risk that people don't know about is what's happening in China. With the trade war going on, with the slowing because of earlier measures to tackle the financial sector problems, China is slowing quite fast. And of course, the Chinese numbers don't tell the entire picture. Now, we also know the world is very well integrated. So when China slows, German capital goods exports slow down. Germany is slowing, Europe is slowing. And of course, the US, after a very strong year last year, this year is going to slow to a more reasonable level. So given all this, I think there is a lot of uncertainty. And the uncertainty about policies is really killing. When you don't know whether there will be 25% tariffs or 0% tariffs, where do you invest? You can't invest here because the tariffs may come off. You can't invest there because the tariffs may stay on. So you can see that the geopolitical uncertainty is something that has business, somewhat paralyzed. Now, The upside is if these go off, if somehow China and the US reach some kind of deal. The problem, of course, is that this seems like a much bigger war between them than just about tariffs. It's about geopolitical supremacy, it's about military might and relative military might. So I don't know if just an announcement before March 1st will be enough to quell the mood and lift it. Certainly the central banks have stepped back and said, well, we were thinking of raising rates because growth was strong. Now the Federal Reserve is seeming much more tentative and saying we'll see how things go. So my guess is underlying strong growth still, not spectacular, but with a lot of risks. And now the central banks are stepping back from the process of raising interest rates and going to watch and see what happens.
Since we're talking about central banks and you talked about how the Fed is probably going to slow the pace down on further hikes, the clamour in India is for a repo as well as a CRR cut. In fact, most bankers that we spoke to before I headed here to Davos said that, you cannot have rates running at this level in India. The RBI and the MPC need to move. What's your own take?
Well, I guess the broader question, I don't want to address the monetary policy question, leave that to the RBI to decide. But the broader question is India, does it have plenty of spare potential? And I think one of the worries is even at this level of growth, which, as you know, is not producing the jobs that people want, at this level of growth, we are seeing core inflation pretty strong, above 5%. So the worry is that we talk about there being the potential to grow much faster, but does it really exist? Do we have the capacity to grow, especially given that this budget is probably going to be a more expansionary budget than the ones we have seen?
What are you expecting?
I have no information more than you have. I mean, there is talk of some kind of an agricultural package. We have to see what form it takes, whether it substitutes for existing packages or adds on to existing packages. And presumably there will be some election year benefits for people. I don't know what it will look like. My worry is that our fiscal consolidation, as the CAG has reported, there is a lot off balance sheet, which...
But that's not new.
It's not new, but the question is, what is the relative scale? And one would love to see a full accounting of how much has been pushed into our public sector units to borrow rather than the government borrowing. FCI is now borrowing. There are lots of places where now we have fiscal expansion, which perhaps is different. Now, what one really needs to do is a full-scale accounting, both for how much we are actually spending now, but also the liabilities we have created for the future. Because, things like this very much needed health insurance program, but also the liabilities we will be taking up if we have a new scheme for agriculture. These are things we need to add up and say, well, we can't roll them back. Can the government afford them, not just this year, but when they're fully rolled out? And depending on the state of the economy, they may or may not be affordable.
If there is a direct benefit transfer scheme that is announced for the agriculture sector, and we don't know the quantum, the assumption is that perhaps a pilot for small and marginal farmers, that will be the first installment. If that were to be the case, and it's not the 2.5 lakh crore rupees that would be required for a full-scale rollout, if it's between 60 to 70,000 crore rupees, is that something that you believe that the markets will understand?
Well, anything that is contained and that still meets the fiscal target, because the government has been very strong in saying we will meet the fiscal target, is something that probably the market will take in its stride, especially given that it expects this is election year, there will be a different budget than the ones it has seen so far. And I think this is something other central banks have picked up. We were asked to make presentations elsewhere. It is something that offers a basis for discussion going forward, and it's something we should think about.
So what was it that you suggested to the government, and what was the response that you got from the government on this?
No, I think what we had suggested is we need a scientific process by which we evaluate how much capital the RBI needs, and based on that we declare a dividend, rather than negotiate this every year around budget time, how much do you need, how much can we spare, etc., etc. Let's do it on a basis...
Do you believe that process is arbitrary somewhat?
Well, by its very nature, it's arbitrary because it's based on what the needs of the government are, rather than what the RBI needs in terms of maintaining its balance sheet strength and so on. So I would start first by saying, here is how much the RBI needs to present a picture of health, because we need a strong central bank. And then anything that is excess should be paid over to the government. It is the government's. The RBI has no call to keep anything that is over and above that. The magic question, of course, is
what is that number? Yeah.
What is that number? And for that, having an objective process of deciding how much that is what Mr. Gandhi was probably referring to. We had a team within the RBI do the calculations, prepare the structure. This splendid young team, which essentially read the latest literature and put it together. And the question is that the basis for proceeding forward? It is state of the art in determining how much capital the RBI needs.
So was that taken forward at all in any form or fashion by the government in your conversations with them?
I think we had a discussion then. We put it on the table. The board at that time approved it in a sense of this is a basis for discussion going forward. The government at that point decided that they needed to learn more. So it wasn't that it was rejected. It was just that we never concluded on that.
So given the work that you did in the past and the fact that there is this committee that's looking at this issue, what should be the guiding parameters?
Well, it's up to the committee to figure it out.
No, but what would you suggest? I mean, what was it that you put on the table?
I think the committee will think very carefully about this. And I think the two or three big issues that it will consider first are that what is the appropriate level for the RBI to maintain a strong, healthy balance sheet, especially when it looks, when it's outward facing towards the rest of the world. The second issue is, okay, once you've decided this is a quantum that is excess, how do we actually pay it out? Because there's an accounting issue in whether you can pay out things that are not generated through profits, but that are generated through, for example, foreign exchange depreciation. And that accounting issue has to be dealt with because that is a constraint. And the third issue is how do you pay it out without monetizing a large part which you cannot really afford to given the liquidity conditions in the economy. All three have to be thought of. My sense is that, previous people have opined the best way to actually pay out a large dividend to the government is to write off the bonds that you hold on your balance sheet of the governments. So the government's debt comes down and you don't monetize the process. That's something to think about, but that's more me speaking with my academic hat.
Well,
All right, meanwhile, numbers flowing in thick and fast. Asian Paints looks like a beat as far as the top line, EBITDA, as well as bottom line is concerned. The company posted a net profit, a top line growth of around 24%, and the net profit was higher than what the street was expecting as well. Margins of 19.7%. The street was expecting a good quarter, but if you take a look at their domestic standalone paint business, that has shown a revenue growth of 26%. Even if one believes that this could be perhaps, a 5 to 6% growth in terms of realization, the volume growth could appears, or rather, one could infer that it is around 20%. The street was working with mid-teens. The company has posted a high double-digit volume growth. So we'll have to wait by for analyst estimations of what the volume growth is. But the reported numbers look like they are above what the street is expecting, led by the top line. The EBITDA margins have come off tad bit. That's primarily on account of higher top line and higher other expenses. Remember, the company had started a new plant, or a new Mysuru plant had come on stream in this quarter, so that's led to higher other expenses and higher depreciation as well. All things said and done, looks like it's a beat as far as Asian Paints numbers are concerned. The stock has recovered from the lows of the day, and remember, from October lows itself, the stock is up around 30%. The street was expecting a good set of numbers. The company has gone ahead and delivered a better set of numbers. What we'll do is we'll wrap up on the. All right, we have Naveen Kulkarni with us. Naveen, what do you make of this 27% growth in the domestic paint business? What do you think the volume growth could be? The company says it's mid to high double digits.
So, yeah, I think the volume growth is pretty high. It could be closer to 20% odd for the quarter. So, looks like significantly higher than what we were expecting in this quarter.
All right. And at these valuations, what would your call on the stock be, and what are the things that you'll be waiting to listen to in the management con call?
So, as of now, we will be waiting for the management to give its commentary on the margin and how the price hikes have been. and what are the pricing actions that can be expected going ahead. So as of now, we'll wait for the margin guidance for more than anything else from here on.
All right, Naveen, thanks a lot for stopping by and giving us your quick take on Asian Paints. So that's as far as earnings are concerned. Asian Paints a beat as far as estimates are concerned. With that, we wrap up on this edition of Mutual Fund Corner. Come back on the other side. There will be closing bell. Markets in Asia, they trade cautious amid concerns over global economic outlook. This after the IMF slashed its world economic forecast.
We very strongly kind of call for operational independence of central banks. I mean, not just the RBI, but central banks all over the world.
As of now, a reluctant bull is making most money. Every time the market gives you a dip at index level, you want to buy.
What CRISIL did on Jan 15 and which became public knowledge yesterday is it has downgraded one of the SPVs.
Sun Pharma has said that this Aditya Medisales, which is basically the current distributor, is going to be transferred to a wholly owned subsidiary of Sun Pharma.
The Nifty's now moved down 30 points.
Our base case for Nifty is around 10,000 by December 19.
Buying direction in FY20 are going to be a little challenging.
Markets are down and out. There's about a 55-odd point cut. 10,906 is where we are at. The market's down almost at the day's low. 78 lower on the Nifty, 251 lower on the Sensex.
Okay, interesting day today. It looks bad, but trust me, it's better than what the index is suggesting today at least, and what the market looked like at noon time. This is Closing Bell. I'm Anuj. With me is Surabhi. Hi Surabhi, good afternoon.
Good afternoon, Anuj. Today, a 100-point range, a 50-point recovery from the low of 10,850. Though, the titans of yesterday, Reliance, IT, these are not the names that have managed to pull back the index. Your thoughts on today's action?
I think today we had the most selling in the first hour itself, Surabhi. Even advanced decline became quite bad. I think I was making this point around noon time that perhaps just from the day point of view, especially if you look at the Bank Nifty today, that's actually outperformed, that perhaps the day low might have been made, and you might see a bit of a recovery. The mid caps have also recovered, and this is what happens. When in the first half itself you have, over the last few days, what was happening was starting at 2:1, 3:1 on advanced decline and ending at 1:2. Today, what you started at a bombed out advanced decline ratio. You're not improved much, but at least not deteriorated further from there, and the mid cap index itself has recovered. So that's, I think, been a good point about today's trade. So that way, I think it's just again re-emphasizing this message. You have to try to buy closer to 10,850 in this market. Today you almost went there, and you have to try to book profit closer to 11,000. I think that's the market's range. You have to respect that.
Okay, that's the market. We've also had interesting numbers today. I mean, TVS Motors, imagine that when there's so much of gloom and doom talk in the auto sector. At least the previous quarter, they seem to have done well. Asian Paints, any thoughts on these stocks? I
think Havells was for me the earnings of the day, along with TVS Motor. I think even Asian Paints is a good number. Look, the point which over the last few days, which has got re-emphasized again and again, is that in this market, the most expensive stocks are expensive for this reason. I think Havells is by far the most expensive F&O stock, perhaps Page Industries after that. TVS Motor, we all know, is an expensive stock. Asian Paints, we all know, is an expensive stock. But, they are expensive because they're delivering on earnings. And that's, I think, one thing which clearly stands out. So I think all these numbers look quite good. I think Asian Paints, what you're seeing right now is just routine profit taking because the stocks rallied a bit. But I think this number is good. I think in terms of the standalone number, in terms of consolidated numbers, I think they are high double-digit volume growth. I think Mangalam was making this point before the break. I think that's also a number which is quite good. There's a bit of a margin pressure, but just like you saw with the case of Havells, and the market will reward you if there's a good top-line growth, solid top-line growth, and if the margin issue is just one quarter issue, I think you're fine.
Oh, absolutely. Then Havells also came out and said that margins will improve from here on, and I think the market really latched onto that as well. 4.5% up on that stock. Well, let's tell you what's lined up on Closing Bell today. The market has recovered, but it's still under pressure, still in negative territory. Heavyweights like the HDFC Twins, ITC and Infi dragged the index lower today. Kotak Mahindra Bank continues to bat for the bulls. Sun Pharma surges almost 6% after the company takes remedial measures following reports of the whistleblower complaints. We will be discussing all of these key trends with the fundamental experts, SP Tulsian of sptulsian.com, Sudeep Bandyopadhyay of IndiTrade Capital, and Sampath Reddy of Bajaj Allianz Life Insurance. Now, we were just discussing some of the major earnings of the day. Overall, how has the third quarter panned out so far? What more can we expect? Naveen Kulkarni of Reliance Securities joins in for that chat. And as always, our technical experts joining in with lots of trading ideas for the last hour.
Okay, we have Ashwini and Mitesh for last hour trades. Good afternoon. Ashwini, your thoughts? We went close to 10,850, have bounced from there, now down 55 on the Nifty. How would you approach it, and what about individual stocks?
There's one very important thing in this up and down, that there hasn't been momentum. I mean, Bank Nifty is used to 500-point moves. Here, 100 points is like, it's enough. So the whole idea is, till you have these mild declines and mild rallies, 100, 120, 140 on Bank Nifty, 50, 70 on the Nifty, it's very easy to take the other side. Till now we were having these mild rallies towards 11,000. Now we are getting these mild declines towards 10,850 on another day. With all this NBFC issue, you would be down 500. But that way, I think at the close, since we should have shorts on financials, you are likely to see some short covering and probably end up 20-30 points higher on Nifty. I don't think there is much of a message to take away, other than the fact that we continue to remain range bound, and we have defended the lower end of the range as well, despite not many heavyweights participating. So that way, Adani Power is a buy with a stop of 50, target of 56. Havels is a buy with a stop of 695, target of 720. And Mindtree is a buy with a stop of 890, target of 925.
Okay, those are stocks on Ashwini's list. By the way, the Reliance Nippon numbers also came in while we were discussing Asian Paints. The stock is actually reacting a little positively. The stock is trending on the higher side. They've done a revenue figure of 350 crores, which is more than anticipated. It's a decline, but it's more than some of the estimates. The profit number that Reliance Nippon has put out is 110 crores, again slightly above some of the estimates. These are CLSA estimates that I'm comparing them with. And for what it's worth, the stock is trending to the highs of the day right now. Mitesh Thakkar is also with us. Good afternoon, Mitesh. Your read-through from the day and trades for the last hour.
Yeah, good afternoon, Surbhi. So, practically it's been days that nothing much has changed, and I think that scenario still remains. We're still in that range. Failure to get past 10,980 has brought us back to 10,850 to about 10,975, 80 on the upside. So I think that range remains. And the way I think the short-term and the intraday indicators are shaping up, I think you might see that this range might be enforced for a day or two more before some kind of breakout or breakdown takes place. So we've been very flat. Typically after this flat reading after a day or two, I think you will see some kind of jerk in one of the directions, and that's what we are waiting for. Till then, it's a stock-specific market. I have a buy on Ajanta Pharma with a stop at 1150 for targets of 1200, and Havels is a buy as well. Keep a stop at 696. Look for targets of around 730.
Okay, well, Havels is already up about 5 to 6%, so has a bit of a momentum play right now. SP Tulsian of sptulsian.com and Sudeep Bandyopadhyay, Group Chairman of IndiTrade, now join us. Good afternoon. Mr. Tulsian, let's discuss Asian Paints first. Numbers, of course, flashing on the screen right now. Of course, it's a stock which has rallied already, but at current levels, what's the call on the stock?
I think excellent numbers, and in fact one has to read into the the background that the company has added the capacity also. If you recall, maybe on 24th or 25th September, the company has commenced their Mysore plant with 3 lakh kiloliter per annum capacity, which is now getting expanded to 6 lakh kiloliter per annum, and maybe Vizag plant will also start in Q4. So here, and that is actually what is seen, indicating from the increased depreciation also, where the depreciation has increased from 95 crore to 115 crore on a sequential basis, indicating that the depreciation of the Mysore plant has been provided for. So I think that excellent numbers overall, in spite of the higher depreciation and the new new project costs having come into the effect, because obviously the capacity utilization ramp up takes time. So if you take that into consideration, apart from the high double-digit growth in the decorative segments, I think the numbers are seen to be quite good. And in fact, I've heard you saying, I've been analyzing these 4 or 5 numbers, maybe Shree Cement, TVS Motor, Havells, Asian Paints. I will rather take the Asian Paints as the best amongst all these 4 or 5 numbers having posted by these companies.
Oh yes, Mr. Hussain, absolutely no taking away from that. I think just to add to that point, what happens with institutional stocks like Asian Paints is that based on these numbers, my sense is that today evening you'll have upgrades to the numbers. So optically, looking at the stock, but tomorrow morning I think you'll have most of the brokerages, upgrading these numbers, and the stock still has cushion from its all-time highs. I think if you see the previous all-time high of the stock, I think there's quite a bit of cushion. I'm not saying that it goes there tomorrow, but just put out the 12-month chart.
It's about 5 to 6% off.
5 to 6% off its peak, and normally. What a great time it was to buy after last quarter, right? When it came out with just 1 quarter disappointment, and that's what you do with great companies, right? You look for that 1 quarter of disappointment to buy. Last quarter, the stock fell to 1100. And from 1100 to 1430, 1450. Just a case study in value investing or in investment.
I totally take your point, Anuj, which is why it's fascinating to draw up the contrast between something like an Asian Paints and what's happened, let's say, to a Page Industries. Was also a classic business, but there the disappointment period, I think, was getting a little prolonged, and therefore the derating on that stock that came through. In fact, today as well, Page, we understand from sources that I think one of the block deals that happened, there was a large marquee institutional investor that sold out of Page today. That stock's still down 1.5%.
I'm not too comfortable with Page Industries, frankly speaking. If you ask me, it's if you see the chart of the stock, I think it's been quite long that it's seen this kind of move. And today, of course, you can't fault one investor for selling after making 40 times.
Yes,
but it's horribly expensive. It's not in a business which can't be replicated, and there are going to be players who are trying to replicate. But anyway, that's a different story. But a lot of stocks, by the way, in the mid-cap market are now seeing quite a bit of recovery.
Absolutely. All right, let's take this conversation forward. We have Sudeep Bandyopadhyay also with us this afternoon. Sudeep, I don't know if you managed to take a look at Shree Cement's numbers. They've actually come out with some very strong margins. There was a bit of a top-line beat as well. How do you rate this stock? And generally, what's the view on cement?
Well, I think the numbers were pretty good. The margin, overall combined margin, if you look at the segments, I think that's pretty impressive. Cement margins were supposed to be under pressure. But under the circumstances, I think the kind of margin they have produced is commendable. Overall, I think the business is growing pretty well, and it's very apparent from the numbers. I think, the cement has a little bit of an issue, and I'm not talking about Shree Cement in particular. I'm talking about the entire industry. While the volumes are growing, the margins are not actually moving up in the entire cement industry. I think it's getting played out across both mid-cap and large-cap and even small-cap cement companies. The pricing power which the industry used to enjoy, they are yet to regain that back, and that's a bit of a concern. Other than that, I think Shree Cement numbers were excellent. Let's wait and watch how the current quarter pans out for the entire cement industry, whether they get back that pricing power or not. I think that will be what we will be watching.
Okay, all right. That's a word on some of the earnings that have come out through the course of the day. The Nifty is just about 52 points on the lower side, still around that 10,910 mark thereabouts. If we talk about some of the stocks that have made headlines today, we should pull up Prabhat Dairy and pull up the intraday stock, the stock chart as well of what's really happened here. It's been on a steady decline right throughout the session and now down 9%. Now, what we know is that for all practical purposes, the entire business of the company is being sold out. Some 90 to 95% of the revenue, I think, comes from that milk business, which is being sold out. And Anuj, there seems to be a lot of disappointment with what is going on right now and the manner in which they've sold the business, not really the company. So what does it mean for the shareholder?
For starters, let me make 2 or 3 points here. In the morning also I had tweeted about it. Of course, I had, I have no sort of negative intention about anything, right? The issue here is the point I was making in the morning as well. If you have a business, or if you have a company which where you're selling a business which is 98% of the company, then what is left in the company, right? I don't like the slump sale kind of moves that happen from the company. You have to sell the entire company. The promoter or the new promoter who comes in has to make an open offer. The shareholders of the company need to have an option. There's absolutely nothing illegal in what Prabhat Dairy is doing. Let me make this on board. I mean, I'm not saying that there's anything illegal that they're doing. There's absolutely legal thing that they're doing. There's absolutely in line with the rules, with the law of the land. That none of the laws has been violated here. Has been breached here. What I was talking about is that if you were a retail shareholder, in the morning, if you sort of got on the bandwagon in the Prabhat Dairy stock, you should have seen what the stock has done over the last 1 year. It's destroyed wealth, and in that case, you should have always thought, okay, there's something wrong here. And the stock was up 20%, and from that point, it's just started to and look at the volumes. It started to fall. Consistently, it's fallen to this Surabhi. And I think today's volumes in Prabhat Dairy, I think would be some kind of a record. I think it's already done, 1.6 crore shares for something like a Prabhat Dairy. Stock down about 11%. So this move does not surprise me. Having said that, there's nothing illegal. It's just perhaps something which the shareholders should have been very careful that something like this happens. You should stay away. Entire company should have gone, and then there should have been an open offer of that. Let me take Mr. Tulsian's thought as well on this one. Mr. Tulsian, now down 11%, started 20% higher.
Senuj, I fully agree with you what you have said, and I corroborate all those things. But let me just add here the points that whatever prima facie I have the figures available, they will be getting 1700 crore for 98.5%. Now, company is going to remain with them. If you take 500 crore is the fixed assets, 750 crore is the current assets. I'm just going quickly, I'm not trying to complicate the matters further. Of that 750 crore current assets, they have 250 crore cash. So if you are going for the slump sale, and I presume that on the current assets you are not going to receive any amount, that 1700 crore virtually will go for your fixed assets, you are making a gain of 1100 crore to 1200 crore on which you will pay 30% tax on a slump sale, or maybe 31.2%, including the cess. So that goes away, takes away your 350 crore. Company says in its press release they will look to distribute maximum as in the form of dividend. So that means you wish to distribute about 1350 crore because company is already having cash and bank balance of 250 crore. That means DDT, dividend distribution tax, will go away to 250 crore. 600 crore in the form of tax. Are you working here? You have consummated this deal for the government tax collection or for the shareholders' benefit? 100 crore is the paid up capital, that means 10 crore shares. 60 rupees you have just gone for the tax payment. And now come on the residual value of about maybe 1300 crore remaining with the company. Will you be distributing that entire amount? I doubt. And if I go by the shareholding pattern, promoters have 50%. 3 OCBs, 3 overseas corporate bodies are holding 30%. I don't know who those 3 OCBs are. So in fact, these all creates the fishy, what you call doubts in your mind that whether the distribution policy will be there, and if they have the honest intention of distributing 1300 crore among the shareholder, why they did not sell the company and gone for the open offer trigger the entire lock, stock and barrel, because they have sold their subsidiary, they have sold their core business. So I agree with you that instead of going for the slump sale, they should have gone for the total complete this one. There would have been open offer, and then that would have given the full value and full benefit to the shareholders.
What a story this one has been. Stocks down about 12.5%, still falling 13%. We have been trying to get in touch with the management to understand exactly what the thought process was on this one. And let's see if we hear from them.
I think that's an important point to put on board, that we are trying to talk to the management. We of course will talk to the management if they're willing to come on air and talk to them. But for now, the stock is down 13%. That would mean intraday reversals would be from 20% higher. I think it opened at 111 something, which was the circuit level, to 80 rupees. Talking about intraday move perhaps of close to 30% on Prabhat Dairy down about 14%.
Yeah, when you're selling 98% of the business, that means you don't want to be in the business. So why not just exit the company? Let someone else come and run it. Let's see if Prabhat Dairy's promoters are willing to come in and answer that question. 15% lower. We will take a break on that note. When we come back, we get chatting with Naveen Kulkarni of Reliance Securities, decode the third quarter earnings season, how it's played out so far, and what lies ahead.